Hi, I'm Bill Storie of the Olderhood Bermuda, and my guest today is Nick Rilley, who is Senior Investment Manager at Butterfield Asset Management. Hi, Nick.
Hi, Bill.
So, another year is just about closing out on us, and I think tumultuous might be a reasonably good word to use overall. So let's get straight into sort of the year in review. There's been increasing inflation, obviously, throughout the year, which has caused downturns over the year in both equity and bond markets, meaning that even the so-called balanced portfolios, I think, have had a tough time. Was that a consistent trend throughout the year, or were there specific events triggering the downturns?
Yeah, I think that's right to point to inflation as the kind of main theme of what's happened this year. And one of the things that's made that a challenging environment is that inflation has not really been a story for around about 30 years. There are lots of people that work in finance and economics that haven't been around for a high inflationary period. So you need to go back right to the 70s, early 80s for an environment where inflation was high and damagingly high. So this environment that we've had this year has been very challenging to get a handle on what's been going on. And there are lots of different reasons for it. So the place you have to start really is the pandemic. So thinking about these big shifts that we had from people staying at home rather than going out, buying goods instead of services, all the money that was pumped into the economy to help households and businesses through the crisis. That's all meant that there's been a lot of disruption in the real world, and supply chains have been disrupted. A lot of people have seen, when you order things, it might take longer than it previously did because of all this disruption. So at the start of the year, inflation was quite high, but there was some hopes that it was going to come down this year. So there was this hope that it was going to be transitory inflation, and then at the end of last year, central banks kind of abandoned that word and said it was time to retire it. So coming into the year, there was worries about inflation, what it might mean for interest rates. So that was really the story at the beginning of the year. Then the big event that happened in the first quarter was the Russia-Ukraine war in February. So that was particularly damaging because of what it meant for commodities. So we had a world where we had goods inflation from COVID. The world was reopening, which meant that people were going out and spending money on services again. So we got services inflation. And then on top of that, we layered on a commodity price shock. So we really had this perfect storm of inflationary pressure. So that made for a very difficult first half of the year. And central banks basically said, we don't really care about nuance anymore. Inflation's too high and we're going to have to deal with it. And that's going to mean imposing some pain by increasing interest rates. So that was really the story of the first half of the year. And then the second half of the year has been a bit more mixed. So inflation has actually shown some more positive signs the second half of the year. So most obviously commodity prices have actually been falling for the last 5 to 6 months or so. So that's been quite promising. We've had some better news come out of the US on the inflation side over the last couple of months. So there's been a bit more optimism around inflation. So yeah, markets had a really tough period, bonds and equity markets, for the first 9 months. And then things have looked better in the fourth quarter as some of these inflationary pressures have shown signs that they're starting to abate.
So I think, is it fair to say then that for inflation, when inflation kicks in, that it has been caused by a particular event? And you've just alluded to two events, obviously, the pandemic and the Ukraine-Russia situation. Is it therefore then fair to say that taking central banks, being the custodian of the money supply, if you wish, that they are obligated to combat that? So in other words, it's action and reaction. So you've got the action from pandemic and the war situation, and the central banks have to react. And it's that double whammy, if you can call it as such, that creates a period of inflation, and hopefully that the reaction from central banks will make some impact. And as you say, in the latter part of the year, the inflation pressure started to lessen just a little bit. Is that kind of the plan going forward, that central banks will continue to react?
Yeah, this is the big question and the big conundrum they themselves are dealing with. So they know, and everyone knows, that their tools work better in some areas than others. So housing is a good example of somewhere where we know that if interest rates go up, it will slow down the housing market. That's not really something that's, debated. It's just something we can see happening already in housing markets around the world this year. But for other things, there's a lot more debate. So food prices, we know, have gone up a huge amount over the last year or so. It's partly COVID related, so disruptions in supply and labor markets and supply chains, and it's partly energy prices have been going up, so there's energy that goes into the production of food, so it's partly that. It's partly companies have been using this as an opportunity to put up their prices. So should the central banks put up interest rates because food prices are going up? So usually the central bank would put up interest rates to slow down consumption. It's like them telling people, slow down with your consumption because we don't want too much demand in the economy. But when it comes to something like food, we don't really want to slow the consumption of food because that would lead to terrible consequences. So they're caught in a bit of a trap where their tools work well in some areas, but not in others. So what they're trying to do now is kind of calibrate it. So they put rates up enough to slow things that they can slow down. So they can slow housing, they can slow consumption, they can impact the stock market through financial conditions, but they don't want to impose too much pain on the economy. And somewhere like the UK is really at the forefront of this. We've got people now that are saying, well, interest rates don't actually need to go up anymore because we've already done enough. So this is the debate they're having themselves. And it's a very challenging period for them because of all these different, contrasting forces that we're seeing out there.
So is there I guess you would call it a consensus of opinion amongst, the experts, the so-called experts, about, looking ahead, where is it going to be going in terms of inflation and interest rates? And, as you say, interest rates have just gone up yet again. What is the sort of consensus from, as I say, the experts in the financial circles?
So there's a pretty strong, or a very strong consensus out there that inflation has peaked. In the US, it actually looks like it peaked back in June, so quite a few months ago. In Europe and the UK, it's more of a recent phenomenon. Probably October was the peak in inflation. And then there is some debate about how quickly those rates are going to come down. So it really depends on what you look at. So for things like durable goods, they went up in price a lot through COVID, through the last couple of years. So they're coming back down in terms of price. So you're actually getting some deflation in some things like used cars. But there's a lot less consensus out there about services inflation. So a lot of the services that are out there are quite labor intensive. So if you go to a restaurant, if you go on holiday, if you go and get a haircut, a lot of these sorts of things they need people. And we know that wages have been going up a lot recently. So there's potentially still quite a lot of inflationary pressure out there in the services part of the economy. And that's really where the debate is. And people have got different views on that. So that's really something we're just going to have to watch next year. What happens in labor markets? What happens with wages? Now, on the interest rate side, the market expects interest rate cuts in the second half of next year. So the market thinks that rates are going to go up in Q1 a bit more, and then they're going to pause, and then there'll be rate cuts in the second half of the year. Now, again, around that, there's quite a lot of debate. Some people think that, there's not actually going to be a US recession next year, even though that's sort of the consensus. It's consensus is going to be a mild recession next year. But if there's no recession next year, then do we need rate cuts in the second half of next year? Or will this services inflation be so sticky that they need to hold rates higher for longer? So that's where the debate is next year. And that's kind of where performance is going to be made or lost next year, and on getting that trade-off right. But we need to see more data come in to kind of have a better handle on that.
Yeah, right. Let's move on to the global bond markets. How have they reacted obviously rising inflation and hopefully starting to come back down again, and obviously the corrective decisions made by the central banks. Are there any categories of bonds that can better weather this storm than others? For example, US Treasuries, etc.
So the first 9 months of this year to the end of September were basically a very brutal period for bonds, and there really was nowhere to hide, whether it was sovereign bonds like Treasuries, corporate bonds, high yield bonds, emerging market bonds, even inflation protected bonds really struggled earlier in the year, partly because it's a bit technical in the way that some of the return is linked to inflation and some of the return is linked to just general real interest rates. So even inflation protected securities didn't really provide any protection in an environment where interest rates go up so much. So it was the worst period since we've got good data, which is the Second World War. So that was the story of the first 9 months of the year. But as this inflation pressure looks like maybe it's abating, maybe the central banks are, tempering their enthusiasm for raising rates. Bonds have recovered a bit so far this quarter. So things like high yield, emerging market debt, so kind of the more risky bonds, they're up double digits quarter to date. So that's pretty good. And then in duration, some of the longer dated bonds have done quite well as interest rates have come down a little bit. But putting it all together, it's been a very tough period for bonds. Obviously, you're locking in future interest rates when you buy bonds generally, and when rates go up, the present value of that investment goes down. So that's been the story. But on the flip side, yields are now much higher than they were this time last year. So if you buy bonds today, you are actually getting paid quite an attractive level of income, more so than you have done for the last decade. So that's a positive as we look forward.
So once again, then, as inflation and or interest rates start to rebalance, perhaps, then obviously bond markets will comply and adjust accordingly. So it's a case, I think, probably of watch this space vis-a-vis the bond markets going forward, because those corrective decisions clearly have an impact on the overall bond market, if I can say it as simplistically as that.
I think that's right. Yeah, there's a lot of uncertainty around, the growth and inflation picture next year. And if we do get recessions next year, and they're quite, nasty recessions, then you could potentially make good amounts of money in fixed income. So whereas this time last year, there wasn't really an upside case for fixed income. Right now, there is an upside case if economies weaken meaningfully next year, or the inflation kind of abates, and then central banks say, actually, we don't need interest rates north of 5%. Maybe they round about 3%, just to kind of pick a number, and then in that case the bond market could do quite well.
Right. Let's move on to equity markets. And I know, sometimes when we talk about equity markets, I don't know, sometimes we kind of have the wrong impression. We look at things like the Dow Jones. But realistically, if you look at the S&P 500, which is a much broader, more companies, obviously, inside the S&P index, if you wish. So to talk about equity markets overall, and maybe I should just give you a chance to do that from over this year 2022. How have overall the equity markets performed, and then are there particular sectors, energy, growth stocks, internationals, whatever it may be, that have sort of performed better, performed worse, etc.? How do you assess the year in review on equities?
Yeah, you're right to focus on the S&P as kind of the benchmark index for US equities, and then something like the MSCI World for global equities. Obviously, it's been a tough year for equities in total, but if you look under the surface, the real big theme of the year has been a big difference between value and growth. So pre the global financial crisis, there was a lot of research to show that buying value stocks, so stocks that were trading cheaper than their cash flows or some measure of intrinsic value was a good strategy. But then we had this long period between the financial crisis, 2009, or coming out of 2009, right through to the COVID crisis, where value stocks were disappointing, and it was all about growth. People wanted growth stocks, they wanted innovation, they wanted cash flows, further out in the future, and the opportunity to make a lot of money in tech stocks, essentially. And then what we've seen this year is that trade essentially unwind in a very dramatic way. So value stocks year to date are actually only down about 4%, which is outperforming fixed income. So it's incredible, really. It's been growth where the real pain has come, and that is, it's orientated towards technology. Obviously, speculative businesses that are not profitable today were very, very popular until really last year. So a lot of heat has come out of that part of the market. So that's been the real dynamic under the surface. And then on the flip side, on the energy side, things like on the value side, things like energy have done very well. So energy has been massively out of favor for years. Its companies have lost a lot of money in these kind of boom bust energy cycles, investing at the wrong time, and then the oil price, crashing. That's happened a number of times over the last 15 years. It happened 3 times essentially. So it was very out of favor. And then this year it's been a beneficiary of higher oil prices. Refining margins have been very strong, and investors have been, allocating to energy again. So that sector has done well. But the growth value has been the real, trade under the surface in equities this year.
Yeah. And I think the impact or perhaps trend towards things like climate issues, and then the ESG market, the environmental, social and governance impact. Is that having an impact? Is that having an effect as people pay more attention, rightly so, to things like climate, the impact of climate change, etc.? How is that affecting the equity market?
It's a good question, and it's a very, very contentious issue that gets very political very quickly. So there's a lot to unpack and debate in ESG. I mean, one of the interesting things to me on ESG is how it gets criticized from 2 different perspectives. One of the criticisms is that it's kind of, it's box ticking, it's marketing, it's sales, and these things that people are talking about don't actually make any difference out in the real world. It's something that's very abstract, and it's not having any meaningful impact. And then it also gets a lot of criticism for being partly a cause of this energy crisis that we're seeing now. So people will say, well, these energy companies haven't been investing into, fossil fuels or energy infrastructure more broadly because they're worried about ESG. So therefore, that's part of the reason why we now have an energy crisis, and we became too reliant on countries like Russia. So the truth kind of lies somewhere, in between, unsurprisingly. And there's a lot to unpack. But I think from a market's perspective this year, the one real takeaway or lesson is that you just need to be a bit careful about, sector exposure in ESG. So if you're an ESG manager at the beginning of the year, or you were allocating funds to an ESG strategy, it may well have been underweight in energy, or could have had no energy stock exposure. It may not have had any defense stocks or other more defensive sectors like tobacco. So if you didn't have any of those 3 sectors in your portfolio this year, you've had a really, really tough time trying to keep up with the market index. So that may or may not be okay, depending on your view of the world, your view of your portfolio, your objectives, all that sort of thing. But the lesson of this year has been that you need to be a bit careful about the exposure that you have and the exposure that you don't have, and what kind of event risk you might be running. So the Russia-Ukraine scenario is obviously a terrible event from a humanitarian perspective, but for the energy stocks, for defense stocks, it was actually something that was positive for that part of the market. So if you weren't exposed there, then that was something that was pretty painful this year.
Well, Nick, I think that's about all we've got time for. The year in review, 2022. I think one of the takeaways, certainly from my personal look at things, is I really think we need guys like you around because there are so many ifs, buts, maybes, swings, roundabouts, etc. If you push one door open and another door closes. And to try and get an overall perspective of where the market is, whether you're in the equity market or the bond, or whether you're in that balanced portfolio, the impact of things like interest rates and inflation is very confusing to people, confusing to me. So I think that's where financial advisory kind of services clearly have been pretty strong this year, and I think they'll get much stronger next year. So I'm Bill Storie of the Olderhood Group in Bermuda, and my thanks again to my guest today, Nick Rilley, Senior Investment Manager of Butterfield Asset Management. This podcast is for informational purposes only. It neither constitutes investment advice nor is it an offer or an invitation to acquire or dispose of any securities, and should not be relied upon as such. Prior to making any investment decision, a financial advisor should be consulted. Products and services are available in the respective home jurisdictions and only in those jurisdictions where they may be legally offered or obtained.